Welcome back, everybody. It's good to have you. We are in a very strange market here in September 2022 in the Milwaukee area. The market seems to be contradicting itself. It seems to be like a little bit of a conundrum. We're going to take a look at that. I also want to do a little bit of an economic 360 to see what's going on in the country in terms of macroeconomics that is impacting the real estate market, that can give us some clues what we can expect in the near future. And then finally, I want to talk about a new trend that I'm seeing emerging all over the US. And it seems like America is ready to turn a page and open up a new chapter. So we're going to talk about that at the end. But before we get there, let's get started with a quick look at the latest numbers, as always, from the local MLS. Not much of a surprise here in terms of inventory, almost 4,000 units, up 4% compared to where we were last year around this time. So that is much welcome inventory, but we are still a far cry away from a normal market. 12,000, 13,000 unit would be more reasonable for our area. So more inventory, but in the grand scheme of things, still very low. What is more of a surprise here is the sales for August, only 2,600 units. That was really a shocker to me. I would have expected more like 3,100. Milwaukee is usually very stable around 3,000 units. You can see it also here in our benchmark year 2015. We sold about 3,000 units back then. And that would actually indicate that the marketplace is shrinking. But that's really not the case, because when you look at days on market, you can clearly see that the velocity is still very high. We're still seeing a lot of competitive deals. And 7 days on market is a very fast-paced market compared to 50 days here, or sometimes 60 days if you go a little bit further back. In terms of prices, we've dropped down to below $300,000, $297,000, which is down from last month, which is seasonally normal. We would expect it for August. And compared to last year, August, we are up 11.4%. So still a very healthy gain compared to where we were last year. So overall, the market is really impacted by the higher mortgage rates that has hit a lot of buyers very hard, especially the ones that were economically stretched already. They're battling now higher rates, and their disposable income is also squeezed by inflation. So we're clearly seeing that impacting the market. And that gives an opportunity to negotiate, especially over $500,000 in the luxury segment. We have seen a couple of very good negotiations. Congratulations to our clients, by the way, in the month of August, because all of a sudden there is some flexibility in pricing, especially at the higher price points. In the lower price points and middle price points, so that's $250,000, $350,000. If it's a nice listing, expect fierce competition. There is no change there. It's just instead of 15 offers, we may see only 3 offers or 5 offers. But in the lower and middle price segments, there is still a lot of strong competition. I think we're going to see a little bit more inventory, but the pace at which the inventory is increasing is going to slow down. Again, seasonally normal and as expected, but at least it's more than what we had to choose from in spring. All right, here's a quick chart I wanted to show you. So also straight out of MLS, if you look on the red line, that's total inventory, and that is a really nice trend coming up here. Inventory is growing, and that trajectory will most likely slow. So we're going to peak out probably here in September or October, probably September, because the new listings, you can see that here on that brown line, that is actually already declining. And that is also something we see every year in fall, that we're seeing less new listings coming out on the market. So the longer you wait, the more you have older listings on the market, stuff that basically hasn't been bought up yet and has already been looked over. So what does that mean in terms of negotiating? I have here the sold to list ratio. And if you've been following me, that you know what that means. So that is basically the difference between list price and then actual sales price. Historically, a normal sold to list ratio would somewhere be 95, 96%. This year we were well over 104%, which means that a lot of properties have sold actually 10% over asking price. And that is changing rather rapidly. So we are at, low, if you want to say that. We're at a little over 101%. So we're still on average selling over list price, but you can see that trend is definitely that this ratio is coming down. and that trend will also continue in September and in October. Let's take a look at mortgage rates. That is probably the single biggest factor right now on the real estate market for a typical Milwaukee first-time homebuyer. That is a difference of about $400, $500 that we have seen in the last half year just because of the increase in mortgage rates. So that really splits the market because it impacts a lot of buyers that were economically stretching. They are now already squeezed by inflation, cost of living is higher, and now the cost of housing or the cost of a mortgage has gone up considerably. An additional $400 or $500 that can make the difference for a lot of people. So that's why we're seeing a lot of a slowdown in the market. And in terms of where rates are going to go, so we caught a little bit of a break about a month ago. Now we're back at the 6% range. And a lot of expert research that I'm reading is they're predicting a lot of volatility for the next few months. It depends a lot where inflation numbers are coming in because that will drive Fed policy. And Jerome Powell has made it clear last week that he's not going to ease off quickly because he's taking inflation now very seriously and he doesn't want to take the risk to ease off too soon. And allow inflation to come back. So he's going to keep his foot on the brake very hard. And we are seeing a significant difference here between the 30-year fixed rate and the 5-year ARM. So that translates to a significant monthly saving. And a lot of people are going that route and they're financing currently a home with the 5-year ARM. If you want to do that, that could be a bet that might pay off, but I would definitely recommend look at the maximum interest rate that ARM could go after the 5 years it's locked in currently, and make sure you're comfortable with that rate where it could be going. But if you're comfortable, it might be a bet that is worth considering because you can make a historically very good case that mortgage rates are typically about 1.8% lower at the end of a recession than they were going in. So if you have a chance to refinance in the next 5 years into lower rates, that may in hindsight be a bet that really paid off. All right, let's take a look at an economic 360 here. One thing that has a huge impact on the housing market is usually the unemployment rate or the job market. I have here the data for the last 12 years, and you can see we're at an unprecedented all-time high in terms of open jobs. So there is no concern here coming from the employment side. On the housing market, inflation still very high. We're expecting it to come in. I think data is coming out tomorrow at around 8%. So that's going to be less than what we have seen last month, but still relatively high to the targeted rate of 2 to 3%. And that's going to keep upward pressure on hard assets such as real estate, because as we're devaluating our currency, it takes more of the same currency to buy the same asset. The house doesn't really go down in value, and it's just measured in currency. Where is that easing up coming from? Gas prices have a big impact on that. They factor into the inflation rate. That's why we're thinking that inflation is going to be a little bit more moderate now in September, but it also has a big impact on consumer confidence. So as gas prices are down below $4, that is good news and consumers feel more confident. So no concerns really from that end on the real estate market. Now here I want to take a quick step back into home price forecasts, because the question is always, hey, is the market going to crash? A home price is going to come down, because we're seeing that a little bit now on the MLS, and I'm going to go into that in just a second. But let me take you back to January, because I always throw a lot of numbers at you, and I want to go back and evaluate the numbers that I had here in January. And you can see all of these guys have increased their forecasts. So these are the latest forecasts that we have now. And even sources like Zelman, who are normally super conservative, have increased the forecast for this year now to 10%. So there is consensus in the industry that we're going to continue to see real estate prices going up, at least towards the end of this year. It's too early to make a prediction for next year, I would say. But generally, the idea is that, or the consensus is that we're going to see a moderation in price increases, but we're going to see price increases also in 2023. And here's a chart that took me a little bit of work to pull the data together. This is actually local real estate prices from the southeast Wisconsin area since 2015. And you can see here how strongly pronounced the seasonality is. So we have every year a peak in summer. You can see a June, August, June. That is usually when the market prices are peaking. And then we have the low point every year usually in January or in February and December. So in the middle of the winter. And this is a very strong seasonal pattern. So a lot of people are saying right now, well, we're seeing real estate prices are coming down. This is very normal and in line with the historical pattern that we're seeing. So we cannot take this as an indication that the market overall is coming down, because what we're seeing currently is completely and totally in line with what we have seen in August, September, and October in the last 10, 20 years. This is typically normal seasonal behavior that we see in the market every year. The question is going to be, where are we going to go forward for 2023? How low are we going to drop this year in winter, in December and in January? And then what is the spring market going to do? Are we going to break the $300,000 line, or is this curve going to be a lot flatter? And is the market going to go sideways? A lot of that will actually depend on mortgage rates and on affordability. And we'll talk about that in a second as well. I have here a survey that I had on YouTube. So thank you very much if you participated. That was super interesting actually for me to see this. So the question was, when do you think is the best time to buy a house in Milwaukee? And this is the answers that you guys came back with. And so no surprise here. Most people thought that spring would be the best time to buy a house. That is, totally in line with the general opinion that we had in Milwaukee since forever. And then second would be fall, third winter. And then this was a surprise to me that only 11% thought that summer would be a good time to buy a house. So if I would have to rank these, and this is maybe a simplification, but I would say fall is definitely my favorite time to buy, regardless if you're looking for a primary residence or for an investment property. I've always had great luck in fall because there's still a lot of inventory out there, but prices are coming down and there's more room to negotiate. Number two, in my opinion, is actually summer, because we're already past the spring craziness. Every real estate agent in Milwaukee can tell you how crazy our spring market is. And so in summer, we have high inventory and we have a really good opportunity. There's competition is coming down. So summer is actually my second choice for the best time to buy. Then third, I would rate spring just because of the choices that you have. There's so much inventory coming on the market that I would say that is number three. And number four, winter, just because it's the lowest inventory. You can still get a very good deal, especially in early winter. So November and December are really a great time to buy and negotiate. But you have limited choices because there's not much new inventory coming on the market. So from a negotiation point of view, early winter is great. From an inventory point of view, not so much. And then the first quarter, so January, February, is usually very tough on the buyer side because there's so little inventory, but a lot of buyers already out in the market wanted to buy. If you are interested more into this, because if you have the luxury to actually determine your timing within the seasonality of the market, I recently recorded a video with all the data and why this is happening and how you can take advantage of this. Take a look. I'm going to put the link somewhere here. But that is a very predictable trend. You can see this here. We have this every single year. So I don't know what the market is going to do in 2023, but I'm very confident that we're going to have a winter and that's going to impact the real estate market. So if you have the luxury that you can time your entrance on the market, then definitely take advantage of that. All right, moving on to a big topic, and that is affordability. So this is a little bit of a shocker here because we have affordability in the US on a national level at a historic low. We are at 98.5 on the NAR index. And what does that mean? An index of 100 means that a median family income can buy a median house. And if we are falling below 100, that means we're really getting into issues with affordability. Why is that index dropping so sharp? So the way the index is calculated is basically a function of home prices, of interest rates, and of wages. And wages have gone up a little bit, but not as much as home prices have gone up. And of course, interest rates have almost doubled in the last 6 months. So with interest rates going so high up quickly, affordability is really falling off the cliff here. And that's why we're seeing this. So keep in mind, this is national affordability. And we have a totally different picture when you look at Wisconsin. So here is the same index. This is just from the Wisconsin Realtor Association. And this is July 2021 compared to this year. So we are dropping down significantly, but we are still in the affordable area at an index of 129. So we still have relatively good affordability. And I want to show you this in the context of the US. So let me walk you through this chart. So this is comparing the median household income against the qualifying income. So the blue line here is the median household income for the entire US, and the qualifying income to buy a house is actually a little bit higher than what most people are making. Now you can see this is a big issue out west where home prices are very high compared to income. This is becoming an issue in the south, markets that have been trending really hot like Florida, like Texas, that are now running into the issue. We have seen home prices go up there 35-40% just last year alone. So that's becoming an issue. And it's also an issue in the Northeast. You know, it's still yellow here, but we're basically, you know, quite on the brink here of turning red. The only market where we still have a healthy ratio between qualifying income and what it costs to buy a home is in the Midwest. And this is going to change the game. I think the Midwest is popping up on the radar for a lot of people, and we already start seeing that on the data. Let me show you that here. This is a map that I have from rent.com. So this is very recent from the middle of this year, 2022. And what they're measuring here is basically a lead delta. So they're saying how many people are moving inbound versus outbound, and they're calculating the difference, and that is the delta. So the blue states are the ones where more people are moving to than they're moving out. There's a positive lead delta. And the gray states are the ones where people are moving out. And you can see a lot of the states that have been very favorable in terms of moving to, like California, like Arizona, like Texas, like Florida, that have seen a lot of people moving there lately. They are literally, you know, collapsing very, very quickly because home prices have shot up so much there, and rents as well. So rents in some of these markets have gone up 30-40%. In Milwaukee, we've seen 5.1% rent increase this year so far. So very, very moderate here. And this is why we're seeing that change. So Wisconsin is ranked nationally number 13 now with a lead delta of 13.5%. South Carolina is the highest. I'm not quite sure why South Carolina is actually so popular, but that's number one. And then the real negative ones are Illinois and the state of New York. I can, let me cover this here in the middle because the Dakotas and Wyoming are really small populations, so quite frankly, it doesn't matter too much what's happening there. But this visually gives you a good indication. So we're seeing a lot less blue around the coasts and on the south, and we're seeing a lot more blue here in America's heartland, with the exception of Illinois. And I have a good guess where the people from Illinois are moving to. McKinsey is saying that 35% of the Americans can work remotely. And when you look at the cost of living, when you look at house prices, as we've seen in the previous chart, a lot of people take their mobility and they look at the map and they say, you know, where can I live in order to escape these high real estate prices? And the Midwest is becoming more and more a center of attention. And this is where I'm seeing a change of trend, because if you would look at Wisconsin 5 years ago, nobody wanted to move to Wisconsin. And that is something that I really see changing now in the last years. All right, so what can we expect for the greater Milwaukee area in the next few months? More inventory. The increase in inventory is slowing down, but I think in September we will still see another uptick, and then we are probably starting to slow down for the winter season. But more inventory means more choices. We're going to see fewer listings with multiple offers. Don't be fooled. They're on a hot property that is priced attractively. There's still going to be multiple offers. And the trick is to know which listings are going to be competitive and which listings allow you to negotiate. You need to know this when you're coming in, so that expertise is absolutely critical for success. So we are going to see an increasing ability to negotiate deals. I'm seeing this more in the higher price points, $500,000, $600,000, $700,000, $800,000. We have seen more room to negotiate there than in the lower price points. And interest rates, like I mentioned earlier, are going to remain somewhere in the 6% range, at least near term. There is a good case to be made that midterm we're going to see rates coming down again. So that's pretty much all I had for you this month. Thank you very much for watching, and I'll see you at the next one.